This is Mark from TradeInform.com and welcome to this video on the Money Flow Index or MFI indicator. As the name suggests, the Money Flow Index uses volume as part of the calculation. Now this makes the obvious step that price moves that are based on larger volume have got more participants and so are more significant. So the MFI, it looks something, if we look at the calculations, it looks something like the RSI indicator, which is very popular. But I think the MFI deserves to be just as popular, if not more so, because it is taking into account the amount of participation in the move. On the screen you can see the SPY Spider ETF here. Between 2018, 2019 going into 2020, and along the bottom is volume. Now it's pretty easy to see, it's not a huge sample size, but it is pretty easy to see that the majority of these bars are green, which is not surprising because the market has risen during this period. However, it is equally fairly obvious to see that a large proportion of the red bars, this is the volume that has occurred on a down day. A large proportion of the tall bars, rather, are red. Even with this relatively small sample, we can see there is a bit of an imbalance. The market that has tended to go up but has large bars tending to be red. And this is a pattern that I expect you can see throughout most periods of history. In the panicky moments when we are selling off tend to have the largest volume. Okay, so this is giving us a clue that volume is at least some significance that is not displayed in any technical indicator that only includes price. Now if we add the money flow index, the MFI, to the chart, we can see firstly how it looks. It looks similar to RSI, it looks similar to the stochastic oscillator, etc. However, we can see that where we have high volume, we have an exaggeration in the indicator. We have the normal overbought and oversold areas that I'm going to talk about more later when I talk about the MFI trading strategy. Now in this spreadsheet I have the calculations for the MFI, and the reason that I'm showing you this is because I believe that if you want to use a technical indicator, you should understand how it is calculated, what numbers and what data it uses in the calculation. So firstly we start off with the typical price. This is just the average price, and you can see I've put the formula there. The high price, the low price, and the close price divided by 3. So it's the average of these three prices. We multiply that by volume to get the money flow, and then if we have a positive value, if you're used to the RSI calculation, this is very similar. If we have a positive close, in other words the close is higher than the previous, we record the value in this column. If we have a lower close, a negative close, the value is recorded in this column. We divide one by the other over the number of periods that we want to use. So I'm using 14 periods. And then we use the formula to make it into the oscillator that we know that is bounded between 0 and 100. Now if you want to calculate this yourself, it's very easy to do so. You can either use this principle here, or there is a link on the screen if you want to download this spreadsheet or a spreadsheet containing the MFI for free. Just subscribe to TradeInform.com. There's also a link below this video if you want to do that. In this video we've looked at the MFI, we've looked at what does it look like, we've looked at why I think it is useful and why every technical trader should know about this indicator and maybe even use it, and we've looked at how you can calculate it. But the key question is it any use as part of a trading strategy? And that question is going to be answered in the next video in this series. So please click on the link and check out that video. And if you want more information about trading the financial markets, in particular about how to backtest your trading strategies to get the trading results that you deserve, please go to www.tradeinformed.com.